Wonderful. Thank you so much. Hello, everyone. So I'm Anne-Sophie, and I'm happy to be joined on stage here already so we have Kamran Shahin, Vice President for Product Management, Digital Assets, and Blockchain at Mastercard. We have Alexandra Soroko, Senior Director for Growth Products at Visa. We're joined also by Mehtaj Syed from Kinexys, MAA Head of Business Development, as well as Joe Vollono, CEO of STBL, and Stani Kulechov, founder and CEO of Aave Labs. So we're going to get into the business of instant cross-border payments. And cross-border payments, as we know, sits at the intersection of money movement, trust, infrastructure, and they also serve different stakeholders. So we talk about consumers, merchants, institutions, and platforms as they rely on a mix of networks, banks, messaging systems, and increasingly also new forms of digital money. Otherwise, we wouldn't be here today. We'll start off with a bit on traditional cross-border payments, then look at what changes when speed increases, what use cases are emerging, and finally, how traditional and digital infrastructures can connect. So we'll kick off with Alexandra, perhaps, to set the stage a little bit. So how do you categorize cross-border payments today, and what distinctions matter most in practice, and which are often overlooked as well?
Hello, everyone. So I would say that cross-border payments, they can have different shapes. They can be P2P remittances, they can be payout by marketplaces, SMB settlement and with suppliers, or big corporates treasury transactions. They can also be, for us as a network, settlement of our clients with Visa, issuers and acquirers. So they have very different faces. And I think the way we think about it is like part of the cross-border was solved, I think, by what the network does. That means think with UK card, you can travel in Australia or Brazil, and actually two parties which don't know each other, they trust because of the brand, and instantly you can actually buy something, a service or a good. But why I'm saying it's solved, it's a messaging part which is solved. So message is instant in cross-border, but the settlement is not. And so I think this is where we are today. So the part of this cross-border is being solved for last years, but an instant settlement is not, and I think this is what not overlooked, but finally there is a technology and instrument which allows to do it at scale.
I think the mismatch between messaging and settlement is also something from an institutional perspective, which is perhaps an even bigger issue. So Mehtaj, maybe you continue this one. Why do institutional cross-border flows evolve differently, perhaps from retail payments?
Yeah, I think it all boils down to what kind of questions get asked when money moves. For a retail client, the biggest question is, did the money reach the other account? But when an institution moves money, there's a lot of other things which get asked. Did the liability get extinguished? Is there a payment settlement finality? What did the auditors say? Is there an auditable trail, etc.? So I think retail is mostly about speed, but I just think that institutional payments are, in my eyes, it's balance sheet movements wrapped around with controls. So when we speak to clients across the globe, on the Kinexys platform, when we try and see how we can institutionalize blockchain solutions, the kind of teams who sit with us and speak with us during those discussions is a testament to the different kind of nuances that get touched. So we sit with the treasury team, the risk team, the legal team, operations, tech. Those are the different teams which get involved, which means those are the underlying factors which get considered when you move money. For a retail flow, you use your app, you send the money, you just get a message that the money moves. So I think institutional flows have many different flavors than just retail flows.
And why does that matter when we look at infrastructure design?
For all those reasons, because now you'll have to make sure that the infrastructure needs to be aligned to the tech risk appetite, the legality of the money movement. So you could use a stable coin to pay a gig worker in Latin America, but that's not such an easy decision for an institution to make, that I'm going to use stable coins to make a supplier to the payment, because the legal team is going to ask them for the accounting treatment. So I think the infrastructure behind the scenes needs to address the different stakeholders who are involved in that decision making and the different kinds of risks which arise because of that. Of course, all of them can be solved, have been solved in different ways. That doesn't mean that you shouldn't look at institutional flows. But the fact of the matter is retail flows are low touch and mostly focused on how good the UX looks like and how quickly I get a confirmation. Probably the institutional flows do not care about the UX at all beyond a point. They just care about the settlement finality, governance, legal regulatory aspects, and hence the infrastructure needs to consider all of those downstream impacts.
Okay, and maybe for Joe and Stani, since you're more on the DeFi side of this as well, do these institutional versus retail distinctions still matter in on-chain systems, or do the lines sort of blur?
I mean, I think the distinctions definitely matter. With retail payments, it's an entirely different consumer and marketplace than the institutional payments, where risk calculus is preeminent. Things like Mehtaj mentioned around technological versus legal settlement or paramount. Risk committees won't allow their institutions and enterprises to engage in these payment flows without clear regulatory and legal frameworks in place, and all of that is still being written as we speak. So absolutely, I think they matter. A lot of the cross-border flows that we've seen to date, especially when you think about stablecoins and their adoption, have been driven by retail consumers in the global south, where they have a very specific use case around hedging a deflationary currency. And so there's a natural uptake for that product. But to get scale with that product across institutions, it's going to require that regulation and legal certainty are in place.
I think that also naturally takes us to sort of benefits and risks that are associated with instant cross-border payments today. So Kamran, maybe where does instant cross-border settlement materially improve outcome for users today? And what new risks as well as constraints come alongside this?
So instant cross-border settlements, we have to take a look at what the needs of the use case are. There are use cases around retail payments, around SME payments, and certain classes of B2B payments where speed matters, instant transmission matters. And that's where instant settlement actually helps. But there's a whole range of other use cases, particularly in the large corporate space, where what we hear from clients is that certainty and compliance matters a lot more than speed. As long as I know that the payment is going to land 1 day from now and that this is the exact amount that's going to land, there's no variance around it, that's what I care about because it affects my downstream planning. But as I said, there's a number of use cases where the instant transmission definitely helps. It helps by, for example, we've seen in certain class of remittances, it helps to reduce liquidity parking requirements if you need to transmit money over the weekends, for example. But any other use cases where there is a significant compliance angle, where there is a heavy element of consumer protections that need to be provided, in fact, I would say both send side and receive side protections, which are typically today handled by escrow arrangements, there a delayed pattern actually often works better. Right? So those are some of the things that need to be looked at.
So there's a trade-off between speed and security. I think that's pretty clear. I think that's not surprising at all. Maybe Alexandra, at network scale, where do you see those trade-offs most clearly?
I would first a little bit compliment on Kamran's point is, I think we're talking about instant payment, but there's a, I'm not saying bigger, but a significant problem of weekends and bank holidays. So to be secure when the payments lands, fully agree. But that's the way how we address a problem. For example, introducing stablecoin settlement within Visa, we actually created the ability to settle with us 7 days a week. So which is impact positively on treasury and liquidity of our clients before even thinking that we need to have this instant settlement. So the kind of sizable and a bigger problem impacting on treasury position and treasury management of the clients, thinking of banks, for example.
I think, Mehtaj, that's again your cue, right? So from the institutional perspective, again, how does instant settlement change liquidity, FX, and risk management across borders?
It's so funny, I work in a bank and I tell my clients you can move money on a bank holiday. It just doesn't go well. But I think the thing about instant, and like the panelists mentioned, the thing about instant money movement is it instantly shifts the risk from point A to point B. Previously, risk was static. Now risk is dynamic, it always moves. Now, I think most of us in the payments business think that we are optimizing for the cost of a payment, but there's many people behind the scenes who are optimizing for the cost of risk. So I don't think risk is necessarily a bad thing, because if you attempt to unlock that risk in a positive way, there is value to be created, and if there's value, then there's commercial benefit. Like, from my head, I manage the EMEA business for Kinexys, that's how we look at it. Is there a risk which is not being mitigated properly? And that if you tapped it positively, there is commercial value. And if without your product, the risk was not being able to unlock, then there's your value proposition. You get a share of that value proposition. Now, if you take a step back, there's different kinds of risks. Of course, this could sound more theoretical, but when we speak to our clients, banks, institutions, and all of the different kinds of money movers, for example, there's broadly 3 kinds of risk which keep coming up again and again. One is the counterparty credit risk. That's the single biggest challenge most of the money movers or entities have, because when your money is not with you, that is a risk where some person in the treasury team is assessing constantly. The amount of risk which gets capped also caps the amount of business you can do with that specific counterparty. So when you're able to increase the velocity of money, your counterparty risk probably remains the same, but you can do more business with the same amount of counterparty risk. So I think the counterparty risk mitigation is been a major unlock. The other one is just liquidity risk. Just, again, take an example of a weekend or Thanksgiving, with all due respect to the United States. I don't know if anybody cares about Thanksgiving outside of the United States, but dollars don't move because it's a dollar holiday. If you had 2 consecutive days of dollar holidays coming up, you have probably pre-funded that position 2 days ahead. Just think of $100 million sitting on the other side for 2 days. If you just had that money in your account, just if a bank like us just paid interest, you'd get $25,000. Just for that money sitting here. So when you shift where the money sits, the risk shifts, but you also benefit from a liquidity perspective. So that's one. And then FX, the biggest hidden risk, I would say. Not hidden, but it's something to definitely take into consideration. For example, if the President of the United States decides to take over some other country on another Saturday, on a Monday morning, you've either underfunded or overfunded your position. So you have a 2-day open FX window, but instant payments can crunch that window down to 2 minutes. So I think there's many positives, but then when you try and address those risks at an institutional level, you have to address how can they be done within the frameworks of that organization. Am I having to touch a new form of money? Do I have to change my behavior? Again, I have an 9-year-old daughter, and I have to explain to her what I do for a living, and then I end up saying, you can necessarily replace the engine of a car with a more powerful one, but you can't just remove the steering wheel and say, sit in a driverless car starting tomorrow. We will end up in a world where there will be driverless cars everywhere. I don't know how many of us today will be comfortable stepping out of this building. And so I think there's a transition from where we are to where we'll go, but risk is not necessarily a bad thing. I think without that risk, there is no business opportunity or business case for many of our businesses to even do what we're doing today. But again, it has to be within the confines of what that acceptable risk appetite looks like.
Then Stani, maybe in DeFi, instant cross-border settlement is the default, right? So what advantages and what new risks does this introduce compared to traditional systems?
Is that me? Yeah, I think what's interesting about these stable coins is that it is kind of interesting because like when you send a payment from your account to someone who you want to do a transaction, and typically you don't really go and ask like, did you receive the funds, right? You just go into Explorer and you see that settlement and happening. And I think that's really sort of like it explains the nature of DeFi. And I see stablecoins as a broader piece of decentralized finance and a smart contract infrastructure and what it actually can do. And I think there's this whole shift that is going to happen over the years where we're starting to move a lot of the infrastructure that we had in the financial rails into blockchain and smart contract based rails. And I think that's what really drives the adoption is that not just that settlement aspect, but actually the risk mitigation for faster settlement, but at the same time changing the whole cost structure of not just payments, but finance in general. And I think from Aave's perspective, our sort of protocol is centered around stablecoins. So it's stablecoins yield on chain, allows anyone to globally to tap into the yield opportunity that necessarily hasn't been that accessible as to global audience. But at the same time, what is happening under the hood is that these smart contracts are replacing the lending infrastructure in the same way as stablecoins are replacing the sort of existing rails, financial rails of payments. And then what comes into the settlement and what you mentioned about opportunities, I think
DeFi and DeFi lending can be there to actually finance some of these settlement risks until this whole migration from like these T+2 or weekend or longer time period of settlement happens between networks, acquirers, and merchants. So I'm actually quite excited what actually DeFi can do for stablecoins and cross globally, and I do think that the audiences are really combined on the infrastructure level. But when you think about it, is these stablecoins and DeFi actually is a sort of a substrate for combining all the liquidity from retail and from institutions, and that creates just a better cost structure and allocation of capital to financial opportunities wherever they exist globally.
So we'll dig deeper into the opportunities and the market practice that comes up here, so real-world application. Kamran, which retail or commercial cross-border use cases are currently driving the most demand here?
So we're seeing a lot of that come up, first of all, in the remittance space, right? And a lot of that is being driven, again, by some of what has been discussed, the need to transact on a 24/7 basis, the need to be able to do it on the weekends, the need to optimize liquidity. So that is one very, very clear driver. Another place where we're seeing a lot of demand come in, although I think it's being solved for in pockets at the moment, lots of maturity yet to come, is in the area of the larger B2B payments, both for large corporations paying their suppliers, as well as corporations doing their own treasury management and cash management operation, which is, of course, I think one of the things Kinexys excels at. Then on the emerging side of things, I think we're seeing with tokenized real-world assets, with the launch of BlackRock's BUIDL, you're seeing a lot of US dollar treasury funds, for example, now being made available on the blockchain, traded 24/7, private credit, commodities. That space is relatively small at the moment, about $36 to $40 billion market cap at the moment, but it was close to zero 18 months ago. So it's growing very, very fast, projected to grow to $2 trillion by 2030 by McKinsey. And if the assets you're trading are on the blockchain, then the form of money you need needs to be on the blockchain and operate that way as well. So small area for now, but a lot of early stage interest in instant payments and orchestrated payments around that area. So that's where we're definitely seeing, I think, most of the demand actually come in. And then on the more traditional side, of course, merchants are always looking for ways to be paid out faster and on the weekends at optimal costs. So we're seeing quite a few inquiries over from there as well.
So everybody kind of agrees that we're moving from traditional to always-on systems?
Always on is actually what we hear about more than the instant aspect. 24/7, after hours, and always on.
Yeah, so that's clearly a limitation we have with existing systems, right? So settlement windows and intermediaries, liquidity, silos, all of that. So Stani, again, from a fully on-chain perspective, this borderless model actually changes, right? Like, what does it change and what problems does it really solve?
Yeah, I think access is a really big thing. I think just the example of thinking about countries like Argentina and a lot of these regions where you've been able to hedge against these national currencies by accessing dollars and accessing stable coins and then dollars is a really a kind of a improvement there. And I think as thinking of that, also accessing to broader financial opportunities. So obviously yield is one of the important drivers because you have to preserve capital against inflation. And also on the other side of the trade is also being able then to take this capital allocation that is happening really well in DeFi. And that's what I think what DeFi does really well is that it just allows this sort of open environment for capital to get aggregated across multiple sources into financial opportunities, whether it's DeFi protocols or something else. And I think the future for DeFi is to then take that capital and aggregate into financial opportunities in the real world. And by using existing data and new sort of data to lend. And that's really interesting because I think that cost of capital it isn't really that expensive. So there's a lot of capital available for lending, as an example. But what really DeFi and blockchain does really well is it enhances the whole cost structure. So if you have ability to aggregate capital and also push that capital into new financial opportunities with more greater transparency, better risk management, better accountability, you can reduce the cost. And by using smart contracts, you can automate a lot of this behavior. And actually, a lot of these decision makers for whether it's lending or payments related risk management will anyways happen by, will be done by non-humans at some point. So I think that there's a lot of opportunity in access, both from financial capital preservation, but also being able to empower financial opportunities by injecting capital globally where it's needed the most.
Yes, so you open up access also for an end user, say, to tap into yield opportunities, right? So, because traditionally in cross-border payments, what we know is that, liquidity and yield are tightly coupled, and that usually comes, benefits, let's say, some intermediaries. So, Joe, I'm quite excited to ask you this one, actually. What happens when these two are structurally separated and when this goes instantly and across borders?
Yeah, it's a really interesting question as we think about who will capture the yield in this new evolving system. And I think the answer is changing in real time. If you think about the traditional model where a user provides the capital and the issuer captures the yield. So take Tether, for example. You give them $1, they give you back a digital dollar, they take your dollar, buy a treasury, and keep 4% for themselves. That business model has been enormously successful for Tether. They're the most profitable, one of the most profitable companies on the planet. It's good for you because you get the utility of a stablecoin, but you do give up the yield. A yield-bearing stablecoin is a different product entirely. It's a security, actually. So it's not a medium of exchange in the way a fungible stablecoin was intended. It's a store of value. It's an asset. And so you can't use it as you could a stablecoin. You have to hold it in its current value in order to use it. If you spend it, you lose that yield. It's also, under the Genius Act, not accepted as a permitted payment stablecoin in the States, which will matter for cross-border, cross-currency purposes. So one of the things that we have developed at STBL is a new model that actually separates the principal of the asset from the yield component. And by separating the two, we're able to offer the yield and the utility. And that works now because, as was noted earlier, there are $100 trillion worth of real-world assets, hundreds of billions over time of tokenized treasuries and money market funds coming on-chain. So the stablecoin user doesn't need to go to the centralized issuer to get their treasury. They can buy their treasury on-chain, lock it into a protocol, get a fully dollar-denominated stablecoin. Ours is called USST. It's just like USDC. And also get an NFT that is the yield accrual right to their underlying collateral. And so now they get the yield and the utility. Why does that matter? Our hypothesis is that we're entering an era where everybody is going to want to participate in the economics of stablecoins going forward. The model that has made Tether so much money is not going to be the model of tomorrow, because everybody sees the opportunity in front of them. And if corporates and enterprises and institutions and even sovereigns can capture some of that value for themselves, why wouldn't they? So they're going to take this yield, they can use it to introduce new products and services, monetize certain business lines, incentivize behaviors with their clients, all the while using their principal stablecoin to move dollars cross-border, cross-currency in real time. And so we think that's the direction of travel, and that's what we're building, and it's a super interesting space to be developing, really at the nexus of DeFi and TradFi.
Yeah, I mean, I think we're definitely moving further away from TradFi, let's say, or at least TradFi is also using DeFi applications and is venturing into the space as well. So if we talk about sort of the bridge between that, Alexandra, as we're talking about these new forms of value that move across borders, what does interoperability actually mean?
Yes, and I actually think we will be all coexisting, rather, for a long time and integrating more and more. And maybe the line will become more and more blur across the time. So the way how how we think about interoperability, like it's a foundation of a network model, is to be able to pay anywhere, anytime, and in a secure way. And why I'm saying it's like gonna be integrated, because the way how at least at Visa we're thinking about that, we're bringing stable coins to the business model and the platforms we already have. For example, someone having a balance on a crypto wallet can have a card, the Visa card, and spend anywhere Visa is accepted. So we're combining the existing business model and acceptance in 150 million locations across the world, and the balance on your crypto wallet with stable coins or other tokens, depending on the wallet provider. So this is integration. We also bring stablecoin for settlement. That means instead of paying in US dollars, it's possible to pay USDC 7 days a week. So we're combining the existing model, which brings security in connecting different markets, different currencies, brings stablecoin. And maybe the third, which is also, I think it's important, we will be coexisting for a certain amount of time, because I think there is overall awareness of generally financial institutions, would say globally, that, okay, we should be doing something about stablecoins, but that would take time to take those decisions, identify use cases, and create infrastructures, and launch products. And so we see also like the importance of the intersections. On one side, you still have traditional institutions having only fiat, but they want to start providing services to actually push money in stablecoins to digital wallets. So we are also deploying and piloting services in that space, specifically in a cross-border, because I think we'll be doing like this coexistence for quite a while.
Maybe Mehtaj, from the institutional perspective, again, how do you think about integrating emerging use cases and traditional?
Yeah, I think obviously I cannot speak on behalf of all the commercial banks in the world, because believe it or not, they're very different in the way they think. We've been in this space for quite some time. Over the last 10 years, Kinexys has been around. The expectation when a big bank talks to a client is that we've got it sorted out. Everything's sticked and tight, and then there is no risk in terms of compliance or integrations, etc. So also within Kinexys, we've already moved $3 trillion on our rails till now. As a bank, we move 10 trillion every day, but just on the Kinexys rails, we've moved $3 trillion without touching a new form of money. Now, so we had to put our head together and like, okay, there's this set of institutional clients. Outside of the US, we are predominantly we have an institutional client base. In the US, we have a really large Chase business. Outside of the US, we had to put our heads together and say, okay, if we want to bring the benefits of a technology to this large sovereign wealth fund or this large auto manufacturer, how do you do that? Because they only understand bank accounts and bank deposits. Like you can have a lot of workshops, you can say all of these great things, but at the end of the day, their accounting teams understand only bank accounts and bank deposits. What we did was we put bank accounts on chain. So we launched something called blockchain deposit accounts. They benefit from the 24/7 capabilities of the blockchain infrastructure, but from a legal, regulatory, and accounting perspective, those are just deposit accounts. So that's one way we said, how can we be adjacent to the client behavior? Because if you have a fundamental departure, the adoption gets tricky. So, I mean, being a commercial bank, we will have to take those views. Of course, the institutions which are on this panel have a different DNA, and hence they can do different things. But being a large commercial bank, you'll always have to think about how do you increase adoption for your primary client base, which is large institutions. So we went about having those blockchain deposit accounts. From our clients' perspective, all they care about is this is a bank account at JP Morgan. Because today when a client asks us for a US dollar account, they don't ask us if it's on cloud or AWS, et cetera. They just ask for a bank account. So we said, we take care of the technology. You have a bank account which can move money 24/7. Now, when you couple that with FX, all the client cares about is, I have US dollars in London, I want to move it to Singapore dollars in less than 2 minutes. Can you make that happen? And if you have bank accounts behind the scene and 24/7 rails, that takes care of itself. So that's one way we went about it. Now, when you have bank accounts, the way the clients interact with those bank accounts is also important. So we kind of enable that through our regular traditional banking channels, through our ERPs, through the payment APIs, et cetera, et cetera. So I think accessibility becomes an important one. But then, in the very recent past, the world of public blockchains come up, and it's inevitable that there will be a significant amount of money and assets on the public blockchain. And hence we said, how do we then get into a public blockchain? being a large bank doesn't always help when you want to make decisions around this. So for us, it was a big step. Then we said, all right, we've taken care of the bank accounts. Our clients still understand deposits. How can we combine the power of deposits and public blockchain? So late last year, we came up with deposit tokens, which represent commercial bank money, but which can now be on public blockchain. The token itself is the deposit, and it can move around on public blockchain. So like I said, I think it's very important for institutions like us, at least, to be very adjacent to the customer behavior. Weirdly, as much as all our corporate clients hate bank accounts, they get comfortable when you have a bank account-based solution. And then thinking about the customer behavior is also important. So once you have a really cool product, how do you make sure that they're not changing too much in their day-to-day? Like I said, as long as the steering's the same, the engine can change, the power, it can be more powerful, you can have a beautiful dashboard. But then that is because when we are speaking to the head of treasury functions, they would be willing to accept all of the solutions we discussed right now because they see the merit. But then there's 5 different teams who are not empowered to make those decisions. And those 5 different streams downstream, whether it's tech or legal or compliance, are somehow still comfortable only with bank accounts. I mean, I'm not speaking about on behalf of the entire industry. I applaud the industry, which is the large institutions who are taking a step forward on public blockchain and stablecoins, et cetera. But I think that is the right mindset to have. But if only the right mindset was so freely available today, the world would be a different place. So I think we as a bank still have to put our hat on and think, what's the most closest to our client behavior? What's the most risk-free solutions we can offer? And then at the same time, how can we package the technology behind the scenes so that they don't really care about the technology?
I think you as an institution have the benefit of seizing this opportunity and to the benefit of your customers, while the customers have the benefit of just relying on you, looking to you. You're responsible. You will manage the risk. They let you do your thing.
I agree. So kids keep us grounded. So I tell my daughter, I have no clue how the iPhone works. I just know what it does. And the next time there's a new iPhone, you just ask, what more does it do? I think the onus of the technology should be on the provider, not on the user. When the technology is still the protagonist, that means the technology is not yet successful. When you don't have to discuss the technologies, when you know that the technology is actually successful. So we tell our clients, we made a bunch of mistakes on blockchain. You don't have to make those.
So, Joe, if we come to you, so we see responsibility shift now as well, right? So trust, risk, the incentives are kind of changing now with on-chain systems, right? So especially money itself is also programmable and it moves instantly across borders. Where do you see responsibility lie after all?
Yeah, interesting question. I mean, I think when you think about incentives with money, you actually have to kind of break it down into different types of money. So if you think about central banking money is a public good. The ECB and the Fed treat money as there's a public mandate to ensure monetary sovereignty and stability. That's different than private money, whether it's a stablecoin issuer or your bank. It's a commercial product. And so the incentive structures are very different there, but the soundness of money, meaning its ability to function as intended as a unit of account, a medium of exchange and a store of value, in both cases is supported by law and enforced by regulation. That shouldn't change when money goes on chain, or whether it's sitting in a traditional database environment in a bank, or whether it's dollars in your pocket. Those principles need to exist regardless of the type of money. Technology, however, does introduce considerations. So, an analogy might be autopilot in the cockpit didn't mitigate the need for the pilot. It just forced regulators and manufacturers and technologists to think about human accountability vis-a-vis technology, and how does that shift? And when we think about money moving cross-border, cross-currency at scale with velocity, it definitely shifts. Risks are different, and they need to be anticipated and managed ex ante instead of after the fact, or else because the sensitivity for problems is so fine when things are moving at scale. at speed. And I think the good news is regulators are doing that, whether you look at MiCA or VARA or in the States Genius Act. You can see these common threads around ensuring that issuers have sufficient liquidity, that assets are backed by high-quality reserves, that protocols have sufficient auditability, attestations are part of the money movement process. So from the beginning of initiating a payment until settlement, every participant along that process has a role to play, and they need to be supervised and managed accordingly.
So then also bearing in mind that we're running out of time as usual. So question to all of you, and maybe we can start with Kamran. We talk about instant settlement, greater interoperability. We're talking about legacy systems, emerging systems, digital assets, traditional assets. So what's the single most important change that still needs to happen for all of this to actually come true?
In my view, it is proper governance frameworks around the transactions that need to happen, right? The new technology enables many types of efficiencies, but and I think Joe put it beautifully when he gave the example of the self-driving car. It doesn't take away the need for proper governance to be in place. Smart contracts can help you codify rules. It can help you automate a lot of things. However, when technology inevitably runs into its limits, you need somebody to be able to go to. You need a common set of rule books. And that is probably the most important prerequisite to achieving true interoperability. So that is definitely, I think, one area, and it means something different for different classes of transactions. And then, because we're talking about more and more of this moving onto the blockchains, there is a tension between the transparency that blockchain provides and the privacy that is necessary for many aspects of the transactions we've just discussed. Solutions for that are still at a very, very early nation stage. So I think that is a second aspect that also needs to be taken a look at, right? And those are just two examples. So it's the processes, the governance around everything that needs to be properly layered in.
Definitely agree that the standards is the first thing that need to be achieved. So we passed this kind of internet moment of 90s where I think we are a little bit with enhancement of how money move globally. I think important part is also the simplification of user experience, this kind of abstraction of the technology from what actually the user does, I think, and knows and experience. To your point about iPhone or something, I think the really UX remains complicated. And most probably, I actually believe there might be two school of thoughts. Are we going to know that there's a stablecoin there? Or the user and sender and receiver will not know. I think both will coexist, depending again on use cases, corridors, and what it's needed, but definitely user experience.
I agree with what Kamran said in general. I think the speed can be taken care of by the technology, but the scaling can only be taken care of by governance. Now, it's a bit like world peace. Like, I think all of us want world peace. It doesn't exist today because everybody has a different definition of world peace and their own interests. But I think starting in pockets which are adjacent is super useful. For example, if commercial bank money between two large banks move 24/7, that's a good enough symbol for the market. If we had a large card acquiring scheme, for example, able to move money between another fast-moving entity, it could be another card acquiring scheme or a bank. I think if you expect the public sector and the private sector to coexist anytime in the near future, it's a bit tricky just because how they define the word governance. But at least within the private sector, you could have bridges being built at least between similar players. And then once you have a cluster of similar players, there will be that bridge inevitably be built between two different clusters. So a bridge between two different clusters, a few bridges between similar clusters, I think would definitely happen in 2026 or mid-27. And hopefully end 27, mid-28, I think you will see one bridge between public and private. And obviously that's over and above what Kamran and Alexandra said.
So maybe to also refine the question, then we're talking about governance now and governance-led digital assets. Joe, do you agree that this is the broad shift that's occurring, or is that one aspect to it?
I absolutely think it's the broad shift that's happening. Governance means a lot of things. I think you have to have operational standards in place, You have to have legal and regulatory frameworks and certainty that exist. And when all of that is in place, the technology can do what it was designed to do. But without those foundations, institutions won't enter, and you won't really get scale. So you could have interoperability, but a limited scale. In the States, the Genius Act was a watershed moment. I spent years working with banks on digital assets, and a lot of them were trying to figure out how to engage in this space, understanding that these crypto-native companies want to put assets on their balance sheet, but because of regulation and risk and compliance departments, they weren't able to actually engage the market. That's all behind us now, and it's in large part because of legal and regulatory certainty. And I think the next sort of catalyst that we'll see in the U.S. in particular is this market structure bill, which is now just through the Senate Ag Committee. And being debated by the Senate Banking Committee for their markups. I was at an event earlier in the week with the White House and Treasury, who had met earlier this week or last week with the banking industry and the crypto industry about the long pole in the tent, which is the stablecoin rewards. While there's definitely two strong opposing views on that particular topic and the implications of it, I think the sentiment is very positive that will move forward, and it's going to move forward quickly. Both the banks and the stablecoin companies have an incentive to move this legislation forward. And when it does, I think it's going to be a catalyst for major institutional activity in the space that's still a bit on the sidelines, even post-Genius.
Stani, then we're talking about DeFi, which is, despite all the regulation that's coming into this space, not regulated at all. So Genius, Mika, Vara, all of them don't touch DeFi at all. So we talk about governance and putting rules into place. Do you see that also happening in the DeFi space, or is that still going to remain unregulated for now and a parallel system, so to speak?
I do think I personally have a view where kind of I prefer the technology not to be regulated, but the actually financial services should be. And I think the same approach will apply into DeFi, where you kind of have this permissionless technology like the blockchain itself. So DeFi is just an extension of the software. But what really matters is then the kind of centralized actors in the space and how they operate and provide services that use the technology. And I think when it comes to DeFi, the tech itself solves a lot of some of these challenges of traditional financial world by bringing more transparency, guaranteed execution with smart contracts, accountability, and also access. But at the same time, it brings new types of risks. So, for example, if you don't have the typical custodian risk, that might translate into risks that might be in the underlying protocols, and other sort of risk related to these assets as well that the protocols utilize when it comes to lending, for example. So I think like a framework for DeFi is really healthy, and I think that's also what is being debated in the market structure bill. I think there's going to be some progress in the European Union and also in the UK and rest of the world. I think there's a catch-up happening at the moment.
Okay, any last words from anyone? Any questions? Okay, because then I think, thank you very much, everyone, for participating. Thank you for the discussion.
So much.
Thank you.
Thanks for listening.
Thank you.
Thank you.